Hello everyone, as usual this is a quick audio and video check. If anyone could type on the window, you can hear me and see the screen, that will be fantastic. Okay, perfect, thank you. Okay, 2 p.m. so time to start. Thank you for joining the live video for the Gamma Optimizer room. We are doing it today out of band because last week we did it, so and it was a short week and I didn't want to have to. So this is the last time we do this, and we'll go back to the usual Friday meetings on this Friday, no? Because this is a full length week. And it was good because it allows to see market behavior today, no? So at least it worked out really nicely. So let's start the video and see what we have for today. In terms of close position, so last week on Wednesday we had a full loss on the VRP 320, and market basically kept crashing, and I allowed that one to go to a full loss because I really wanted to see the system. Then we have an early exit for the one on Friday, which was a profit. I know we should have made money, and if you were late to that, you should have at least gotten out at break even. So I made a little bit of money on that one. Definitely it was not worth holding positions while the market was basically correcting. No, we have a tremendous correction, and it's better to step aside. No, so we are currently on hold on all of the trades. We are not doing any trading right now. We're just waiting for the market. I mean, there is no need to trade. There is no obligation to trade. No one is telling us we must trade every day. And in particular for the type of strategies that I do, if I don't see an edge, there is no edge. I mean, there is no point on forcing the edge if it's not there. Dealers were substantially late to this play, substantially, and for you guys that have been attending my live videos, you know that I had been pounding the table on this. Now the dealers were mispricing risk consistently probably for the last 3 weeks, you know. And it's kind of interesting that they allow this misprice of risk, and they got burned. They got badly burned the last week on this. So anyway, let's look at the market regime. So the GT level is well, it changes a lot, no? But when I prepared this slide, it was 4,654. Now it's around 46. But it really doesn't matter the exact level. The thing is that we are more than 200 points below it now. So we are deep short gamma. It's like 4% or more below. Gamma imbalances are massive. We have 40 billion buying, 44 billion selling, and lots of hedging. It has to be done. So that should provide tons of volatility on any direction, and we are seeing it right now. We are seeing a massive bounce of almost 100 points bounce from the loss of the day, and half of that bounce is probably hedging activity from deals. It's a lot of gamma hedging that has to happen on any direction. Of interest is that pretty much all of January we had been short gamma. No, I think we had been long gamma just for a brief periods, and then consistently short gamma. So that's something to keep an eye on. Like the market needs to somehow make it for the GT level eventually, but it is interesting that we have been short gamma for 3 weeks. Also of interest is that dealers are finally starting to price the extra risk. Only after a 10% correction, it took a whole 10% correction for options dealers to actually start pricing some risk on it. I think they are very late. I think that is too late for that. I think the market is now on the verge of a recovery and finding a bottom, but which is good. I don't complain. I mean, I complain in the sense that because of the low implied volatility, we miss on a set of trades for variance experience extraction. We lost money there, but the good thing is that now going forward, we should make good money of them, because if something is true about options dealers is that they don't reprice down that fast. You know, they usually take a long time to reprice down. So implied volatility should be sticky, it should be expensive for a little bit, and that will allow us to do good trades. No? And I guess that's kind of the gist of the current environment in terms of gamma hedging. I don't know, I still don't know. I mean, I will keep pointing out that it is really interesting that options dealers miss out on this volatility, which is interesting because it was visible to all of us. No, we had visibility into this since probably 2 weeks ago, and yet options were not pricing this. In terms of realized volatility, close-to-close volatility, you can see the values for the past month. It has been 18, which is an elevated for month to date, but you know, the last week is 30%. Is gigantic volatility for weekly volatility. Is huge. It's so big that it's basically crash-like levels. Now that's the kind of stuff you see in the midst of a crash. Now it just shows that there is no liquidity in the market, that all liquidity providers went out of the market at once and basically are letting the market do whatever it wants to do. VIX is at 35, which is nice, no? At least finally options are being price elevated, more according to historical terms, but it is late. You know, this is what I mentioned. I think that the overprice arrived when, you know, there is no more point. I don't think that the downside potential from here is that high. No, so dealers are now overpricing options when most of the move has already completed. And I left this one last week. No, I remember this. Whatever is in quotes, I say options are being repriced, but still not expensive enough for the expected near-term risk. And yes, look at what has happened. No, like since Tuesday to here. I think dealers have been taken to the cleaners. I don't think they anticipated the volatility, and I think they are suffering a lot of pain. And I think that that's also showing today in the sense that they are being forced to hedge really, really fast. And they are hedging faster than usual and readjusting. You know, they are trying to overcompensate for the miss, and the options will remain expensive for at least for a couple of weeks. And I hope so. I really hope that options remain expensive for a while so we can go back to do our own VRP trades. By the way, folks, remember that you can ask questions anytime. Okay, I have a question. 18% RV for the past month is seasonally very high. Yes, it is extremely high. For January, January is supposed to have like 10% volatility, no? January is supposed to be this month when nothing happens. I think that TC, you posted this chart before, no? About what was the seasonal volatility, and it's supposed to be really low, and we are getting a huge amount of volatility. And imagine by the end of the week, no? This one only includes the period, you know, this is because we are on the 24th, so this is including the period on December, which was kind of like quiet. But by the time January ends, like when all January is included, it's going to be one of the highest realized variances in history. No? It's pretty much crash levels to me, at least in weekly, it's crash levels. So yes, we have really high realized variance. So 2022, it's interesting because I was expecting, you know, you guys recall that at the end of the year, I was expecting to have a very volatile January, but not at this level. Okay, I have a good question. Like, why are there two lines in the realized variance section of the variance after? What is the difference between the blue lines? Very good. So there are two. I will answer here, and then when we go back on look at the variance center, I can answer that as well. But in general, conceptually, it's just because realized variance is always measured in a time frame. No, there is no such thing as instantaneous realized variance. It's not like a speed that you can measure the speed. You have to pick an interval. So the two lines are different intervals. The dark line is the interval from the moment the market opened until now. So that's the realized variance since 9:30 in the morning. Okay, so it's showing you. So as time passes, the interval gets bigger and bigger. Now, by the end of the day, it shows you the full intraday realized variance since the market opened until the market closed. The light blue line is called the RV30 or realized variance for the past 30 minutes. So it just shows you what has happened in the last half an hour in the market. The reason I have the two lines is because I want to see what is happening, because in the afternoon, because a lot of time has already passed, realized variance will move very little. No, the total realized variance, even if there is tons of volatility, the final amount will not move that much because there are plenty of data already there. But if you measure by half an hour, you can see how volatile the market has been in the last half an hour, and it gives you an idea how liquidity is progressing throughout the day, and that's why I have two lines. No. Okay, so in terms of coming back to volatility, it is very volatile. Dealers were completely missed. They got burned. There is no other way. They felt pain. They are losing money, and they have to compensate that money loss somehow. If you look at the term structure, you notice that they are compensating right now. They are finally, it's a full inversion of the curve. The curve is fully inverted. And remember, the curve last week was already in end of the world mode. So I don't know. Yeah, I'm sharing my screen. I hope you guys are seeing what I am seeing all of the slides. Oh yeah, I wasn't going into the variance center. I was just talking. I'll go into the variance center the second half of the presentation, and I'll talk about realized variance again. So in the presentation, you can see that implied volatility is being repriced, and it's substantially high. It's elevated, it's massive, in particular in the near term. Like the one for today is 70%. It's like crash level type of overpricing. And it's good, it's welcome. It's welcome to see, but we should have this particular setup last week. We should have this since like a couple of weeks ago. The good thing is that as the market goes up, and I think the market is moving up right now, as the market goes up, the volatility will start decreasing. But the good thing about dealers is that dealers got burned badly. And by badly, I mean lots of money. They got burned badly the last couple of weeks. They will not lower implied volatility as fast as the market is moving. So it will provide a nice imbalance that we could take advantage of. So right here in the curve, there are many of opportunities now for those of you that like to play these things. If you like to play the long game, there are plenty of opportunities here, in particular on the middle section of the curve. We could bet that the curve will return to contango eventually, and you can do a play for a contango play. You can do a contango play, and I think similar to what we did last year around October, November, I forgot when we did that. I recommended a pure VIX trade, like a futures VIX trade, and I think maybe something like that could be recommended. But not right now. I mean, right now, forget about any volatility trades. But once the market comes down a little bit, we can go back to this and play the curve. I have a question. Is there a structural way to exploit when dealers underprice risk apart from downside lotto? Well, there are many ways to. If risk has been underpriced, you could play this with calendars. You could play this with even butterflies. Now, butterflies to the downside work really well in index options, and of course the downside lotus. I mean, it's really hard because options in general are an imperfect replication of volatility. So even if we knew that they were mispricing volatility, it was very hard to come up with something that didn't have a directional risk. But yes, in general, the best way is to go long volatility. You could even go long the futures, no? That could have been a way to play. You pick a 2-month future, February or March for VIX, and you could have gone long that future, and you will be making good money today. No, that's another good way of playing if you think that there is a misprice. Right now, the play is the opposite. No, we need to short futures some way or short implied volatility some way, but not yet. So the good thing, the thing that I want to send here, the message I want to send about implied volatility and variance or experiment is that this is a great setup going forward. I am not in a hurry to exploit it yet. We still have a Fed meeting on Wednesday, and it still could move the market. There are no upside to the meeting. In other words, there is no such thing as a positive surprise from that meeting. The meeting can either be complete non-event, or it could be a massive event if they decide to announce something that the market is not pricing yet. Notice that the market has taken a long time to reprice through Fed expectations. Originally, when the Fed announced the new plans, nothing happened in the market. No, the market actually kept going up and up and up. It seems that the market didn't believe the Fed. Then we got inflation results that were dramatically high, and yet the market kept going up on the same day. And finally, it took like a couple of sessions for players to start repositioning themselves, and finally reality was sinking in. So now markets are pricing some kind of moves from the Fed, but I still think the market is not pricing a bazooka Fed, a Fed that is decided to fight inflation completely, and there is still the potential for a tremendous negative surprise on the meeting on Wednesday. No, that's one of the reasons I don't want to do anything. Hopefully nothing happens on Wednesday and the market just continues whatever it is that it's doing, but there is no positive. For those of you that have been around for a long time and are thinking that the Fed will do something that will calm the markets, there is no way they can do it. There is no way. Because the current market reaction, this is not a tantrum. This is not the market sending messages to anyone. There are no messages to be sent, you know. This is just reality. There are portfolios that are being rebalanced. There are people that are reallocating resources into other areas of the market, and that's what is happening. This is not a capricious thing. This is systematic, it's clever, it's rational, no? And the Fed, I don't think the Fed is even looking at this. The Fed they have more important things to worry about. They have inflation to worry about. That is a tremendous concern. There hasn't been a concern since 2009. I mean, since even longer, but I mean since the financial crisis when the Fed started tremendous stimulus to the economy, they have not had to contend with high inflation. Now they have, and I think they are extremely focused on that. So if anything for Wednesday, I might play an end of the world lotto. So if the market from here to Wednesday recovers to the 4,400 level and volatility comes a little bit, I'll play a complete end of the world lotto just for fun, just in case they say something bad. But in terms of that, they say something that will make the market rally thousands of points, forget about it. It is not going to happen. Anyway, and that's one of the reasons that VRP trades are still on hold, and we will not do any. Well, today we don't have trades, but tomorrow I don't plan to do any for tomorrow or Wednesday. Maybe Wednesday, once the decision is announced, maybe the door is open to new trades. So looking at realized variance, here you can see how option dealers are being born right now. Remember that the blue line is intraday realized variance and the red line is VIX. And notice how in the past, the only time when this happened was during the crash. No, you notice that realized variance started going up and VIX was not reacting, but VIX started tracking realized variance finally until it overshot it, and then on the way down, VIX remained elevated. That's a typical volatility behavior, and volatility is very sticky. Once it goes up, it takes a long time to come down. And dealers allowed the same thing to happen this year, even though it was telegraphed. You know, you notice that the red line in 2022 is going up, but the blue line is going up massively, catching up with VIX. Basically, it's like almost catching up with VIX. Dealers allow realized variance to overtake them, and it overtook them today. Today, VRP flipped negative, so dealers are suffering right now. And also, well, the blue line being like this shows that liquidity is appear. No one is providing liquidity right now, and that's bad. No, nothing will happen in the market until liquidity providers come back. Don't hunt for a bottom until liquidity providers come back. I know they might take a while. I guess you may miss 100 points from the bottom, but who cares about 100 points? I mean, if there are thousands of points to the upside, like, you don't care about 100 points. Wait for liquidity providers to come back. And when will liquidity providers come back? Look at the realized variance. If it starts to drop towards 15%, then that's an early sign. No, at least 15%. You know, remember that the magical line is 10%. You know, below 10% is plenty for liquidity, but at least allow the market to show that the liquidity providers are coming back. And also, finally, if you see VIX lower than realized variance, then that means that dealers are starting to see the future, and sometimes they're actually really good for that. Like, they start to, if they start lowering implied volatility, forward implied volatility below current intraday realized variance means that they are not seeing that much, and that could be also an early sign of the bottom. That usually happens around crashes, when dealers don't want to keep repricing thing. And also remember the realized variance doesn't care about direction. So for instance, today the action today is that the market is bouncing massively, and the massive bounce from the from the lows of the day increases realized variance, but the market is going up. No, so notice realized variance doesn't have any directional bias. It can be higher even if the market moves high. So it could be that point where, if there is this point where VIX is lower than realized variance, it's a great sign that we are approaching or we are already bottom. Okay, so keep an eye on that, folks. And of course I'll mention it. No, I'll mention that. This is the variance risk premium chart. I'm just showing it just for fun. The red line is variance risk premium, and the line is until yesterday. I don't have the data point for today, but notice that yesterday they kiss the blue line. Today it is red. Today the red line is below zero. So that means that exactly 1 month ago, whatever volatility deals were selling in options is completely underwater. They didn't make money for the past month. And it probably will be negative for the rest of the week. Probably variance risk premium will be negative for the rest of the week because they didn't anticipate a 10% correction from the top. No, even though all of the hints were there, they didn't reprice. So right now, variance risk premium is very low and going negative. Okay. Because of that, there is no point on doing VRP trades. Like, why we will do VRP trades if there is no variance risk premium? They are called VRP because they are variance risk premium in extraction. And if variance risk premium is negative, it means that we should not do them. No. If I mention here again, if we see VIX less than intra-day RB, then I might consider restarting the trades. No, that's kind of my restart parameter right now. In terms of ambiguity, no factor. Ambiguity is there, it's good that we have it, it's a stock around 0.13, market is very volatile. It might start to come down with this current market action, but it has not been a factor. No, whatever is happening right now has nothing to do with ambiguity. It's more about exogenous factors like interest rates going up, inflation going up, things like that, like the full rebalancing of portfolios. So ambiguity for now is not a factor, but I just put it here just because I know some of you guys like to see it. So that's the reason I put it here. Okay, in terms of the trade plan, I don't have any VRP trades for now. So the only thing I might have is a lotto play on Wednesday, just in case. I mean, just for fun. The way I see this is every time I play those lottos, nothing happens, and that's good. So I'll play it at end of the world lotto just in case the Federal Reserve does a rise of 50 basis points on Wednesday. No, that's completely unexpected. No one is expecting that. There are a few things that no one is expecting. No one is expecting interest rates going up on this meeting. No one is expecting 50 basis points or the reduction of the balance sheet. No one is expecting that. And all of those things could be announced, no? But I mean, the probabilities are very small, but we'll see how terrible the market is at pricing then. And if there is any lotto there, I'll play and I'll share it with you guys. Okay, so let's take a look at the variance center. If I recover my mouse, my mouse is in some place. Okay. Let's look at the variance center right here. So very volatile day, as you can see. Intraday realized variance is 34.19. So I have a question. VIX is higher than RB, right? Has been most of the day. Usually it's always higher, no? Usually VIX, like if you really go historically, you'll see most of the time VIX is always higher than realized variance. The only times with VIX is not higher than realized variance is when you have massive moves up. So for instance, what is happening right now, if you notice from 12:20 p.m. the market was at 4,223. No, the market has basically bounced 2% more than 2% since the lows. Okay, what happens here is that RB increases a lot. There is a lot of realized variance because the market is moving fantastically strong to the upside, and VIX starts to collapse. So that's the only condition where realized variance could be higher than VIX, because because the market is going up in a violent moves to the upside, and VIX, even though it's supposed to track volatility, VIX tends to track only downside expectation. So for today, I think right now realized variance is 34.43, and I think, what is VIX right now? VIX should be right now VIX is 34, so they are pretty much equal. No, so right now I will say that there is a decent chance that the bottom is in. I am not saying that today is the bottom, but I'm saying that there is a decent chance. And don't look at the values right now. Let's wait until the end of the day. No, let's wait until 4 p.m. and see what kind of realized variance we got, and see what kind of VIX we have. And if realized variance is higher, then that's a good early sign that maybe a bottom is being stuck. Okay, or at least that we are closer to the end of the downside trend than not. Okay, so that's a good early sign. But if the market starts to collapse again, then VIX will go higher. Notice how stable intraday realized variance has been. At least the dark blue line, which is the one from the open, it has been substantially higher than 30, which is too elevated. This is crash level elevated. No, so I expect this to close around 31, 32. So we'll see what VIX does, and then I can explain the two lines. Now you can see the dark line is more stable because more data is being added to it to compute realized variance. Now, so the dark line is computing realized variance from the moment the market opened, while this light blue line is RB30. I don't know if you can see the pop-up help. If you browse your mouse over it, you can see the value, and it says RB30. It is the one in the last half an hour. Right now they are matching. They are matching, and most of the day they have been matching. There have been just some periods where it has been lower, but right now they are kind of matching. The market is very unstable, and it's very, very unstable right now. Look how far from the GT level we are. I mean, it's incredible. 251 points below the GT level. This is, I know some members of the room track this. I think this is one of, since the crash, I think this is one of the highest distances we have had from the GT level. Surprisingly, there is not much kurtosis, but I think that when the day is so volatile, when we have moves that big, it's very hard for kurtosis to be high. Because remember, kurtosis is measuring, it's a measure of how big the tails of the distribution are. So when the day is so volatile, the tails tend to be small because most of the moves will be compressed within the body. It's like gigantic moves. There are no small moves. All of the moves are gigantic. So it's very hard for kurtosis to be high. In fact, I expect it to be low because most of the individual moves, minute to minute, are intense. We are having like intense moves in terms of realized variance. So kurtosis is not that much. But it doesn't matter. I mean, what it means, what the most important number here is this. When realized variance is higher than 20, it means no liquidity. And today we have 34. Like, where is liquidity to it? There is no liquidity. No liquidity providers are in the market right now. There may be one or two. That's it. Everyone else turn off the machines, turn off the computers. No one is providing liquidity. And for those of you that really want to hunt near-term bottoms, wait for this number to come back to something decent. So, of course, it's not going to draw back in a single step. So maybe the next step will be like 25. But let's see the trend. Let's see this, like tomorrow, let's see some 25s tomorrow. Let's see some 20s on Wednesday. Let's see some 15s on Thursday. If we see that, then that's a good sign that whatever is happening, that the liquidity providers are feeling good about returning to the market. But, liquidity providers tend to be the smartest people in the room. So if they are absent, we should be absent too. Okay. I think that's my take right now. If we should do whatever they are doing, and they are basically taking a break, and that's what we are doing as well. In terms of historical realized variance, you can see that what I was mentioning, that option dealers were losing money. You notice how realized variance got closer and closer, and this one is from yesterday, but the one from today, you'll notice that the realized variance overtook. VIX. They lose money. They were terrible on this move. Let's see what else can show here from the variance center. No trades locally. I know some people still do the 520s. I don't know. Yeah, and it is attractive. It's like 3% from where it is, but I'd rather don't take anything today. You know, it's better just to, you know, let the dust settle and see what is happening. I know some of you guys, you love to trade. You are compulsive traders. I am not. I am a guy that like to trade when the conditions are right. Right now, I don't see anything for me. I don't like to trade down, for instance. Very, very few times I do downside trade. So I just wait. I think that's kind of my strategy right now. Okay. So I think that's all that I have for today. If you guys have any questions, I'll be more than happy to answer them. I think the main takeaway from this is just let's be patient. At least let's wait until what the Fed has to say. If you are going to position for Lotus, okay, so downside Lotus, we could position for the very, very near term, you know, 1, 2, 3 days. If you are playing upside action, I think, of course, you know, the rest of the year, 2022 is a long year, and we are only like 3 weeks in. So the odds of a high gear towards the end of the year are substantially high. And if you want to play, then do those plays with a lot of convexity. For instance, Japel posted a good trade. That's a very, very convex trade, where you risk $60 to make 2,500. I mean, who doesn't like those kind of trades? No? you're making like 40 times the risk. Those trades are good. If you're playing Lotus, that's the best way to play Lotus, 40, 50 times the risk. Lots of convexity, lots of time. No, that's kind of my recommendation. Anyway, I hope to see you guys in the room. Thank you for attending. It's always a pleasure. And hopefully this Friday we'll go back to the usual time and the usual software as well. No, I do YouTube videos because we might have clashes with other analysts in the site, so that's what I do YouTube for today. But on Friday we'll go back to the original schedule times for the live videos. Take care, everyone. Thank you for attending.